All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Friday, everybody. Today is August 14th, 2026. Our top story this morning is what's going on in Japan. Or I should say, what has been going on in Japan for pretty much the last 2 weeks. And you don't really hear a lot about this. You turn on the financial press, it's nothing but my tech stocks and my data centers, and the demand is insane, right? Same bullshit that they've been running for 3.5 years now. What they're not telling you is that this massive run that we have seen in stocks in the last 2 weeks, S&P 500 making a new all-time high yesterday, NASDAQ almost back to its all-time high. This massive run that we have seen started, you can trace it, July 30th. It started with the intervention in the Japanese yen market that Scott Bessent did with the Japanese authorities, the 30th and the 31st. And ever since then, we've seen some pretty interesting things. We have seen the NASDAQ has gone up in a straight line since July 30th. We have seen the Kospi, the South Korean tech index, had its best day ever the following morning, July 31st. Massive single day rally. The Kospi has gone up since then. It's also gone up slower. Volatility has been greatly reduced in South Korea. People are piling back into the same trades that caused all that mayhem, ultimately culminating with the collapse of Leopold Aschenberger's hedge fund and Citadel buying it for pennies on the dollar. Now, the other thing that has happened since that big intervention, which was the biggest one in history, by the way, these interventions are getting more frequent and larger each time they do it. But the other thing that has happened is the yen has just resumed weakening almost instantly. The yen, there was a big step change down in that USD JPY chart. We'll look at it. The yen did suddenly strengthen as Secretary Bessent sent a whole bunch of dollars to the Japanese, or actually it was a bunch of euros for them to dump and then prop up the yen. But then the carry traders just piled right back into that trade. They started borrowing yen, shorting the yen again, and buying all the things that they had been buying with the yen carry trade all along, South Korean, U.S. tech stocks. They're doing the same thing. And so, the yen has just resumed weakening, and we've actually got we've got Japanese finance officials are out trying to jawbone markets today, trying to tell people any day now we could intervene again. We'll do it anytime we want to. So, the implication is you should stop shorting the yen. They're trying to verbally get people to stop doing what they've been doing all along. Now, look, what Bessent did is Bessent gave the government time to do nothing when he supported the yen. The underlying weakness here is the fiscal situation in Japan. Japan is spending too much money, as they have for decades, and it's being supported by artificially low interest rates and some of the most dovish monetary policy in the history of the world. You'd make 1920s Germany blush with what the Japanese have done. Now, so the yen carry trade is being piled back on at a rather alarming rate, and it is juicing stocks considerably higher. Now, as all of this is going on, you have got the U.S. just completed the most expensive 30-year bond auction since 2001, which, gosh, that was kind of a long time ago. Now, that number is a little bit deceiving because the U.S. didn't do any 30-year bond auctions from 2001 to 2007 because of budget surpluses in the 90s. We don't need to get into that. So, the 30-year yield had been higher in some of those years that they didn't issue any 30-year. But this is the most expensive auction since then. 30-year Treasury interest rate is the highest since 2007, approaching 5.25% and rising. What's going on here? This is the market is telling Uncle Sam, F you, pay me. I am not going to lock my money up for 30 years while you're juicing liquidity in Japan, inflating stock market bubbles. I'm not going to give you money for 30 years at 5% interest. I want more because I think inflation is going to be higher than that. And would you lock up money for 30 years now at a 5% interest rate? Hell no. So the government is having to raise what they're paying in interest. And coincidentally, interest on the national debt has reached $1.25 trillion a year, the second biggest line item in the federal budget, surpassing defense. Only Social Security is bigger than interest on the national debt, and it won't be for long. because interest rates are rising and the debt pile is getting bigger, which means sooner or later, actually probably within single digit years, probably before the end of this decade, interest on the national debt will be the single biggest line item in the federal budget. And of course, one of the things that's driving that massive line item in the budget is defense spending. And we've got President Trump is out with an executive order this morning about the Navy. He's ordered two things. First of all, he is allowing foreign shipbuilders to build American warships, and he is ordering the Navy to go back to the steam catapult for the aircraft carrier. The steam catapult thing, that's a little controversial. The newer Ford-class carriers use an electromagnetic catapult. It is a big, highly complex piece of electrical equipment. It saves a lot of room on the ship. It also extends the life of the airframes because it's a smoother acceleration. It doesn't bend the jets as much as the steam catapult, which is far more brutal. But at the same time, it's had performance issues with the first few iterations of the Ford-class carrier. A lot of downtime, a lot of problems, and it's delaying delivery of subsequent ships. We've got 3 carriers under construction right now. The Kennedy and the Enterprise are too far along for this executive order to matter. So really, it's the USS Doris Miller, which is scheduled for delivery in 2034. It looks like President Trump is trying to pull that forward with this executive order. There's pros and cons to this. Going back to steam, it's going to take up more room in the ship. There's downsides to it, but at the same time, they're trying to speed up the delivery because, we're probably going to need that carrier sooner than 2034, unfortunately. Now, the other part of the executive order was on foreign-built warships. Because the U.S. forgot how to build warships. But there is a law in this country that says warships have to be built for the U.S. Navy on U.S. shipyards and U.S. soil. But there is a line item in that law that gives the president a way out. If national security is at stake, we can have foreign shipbuilders build our warships. President Trump is tapping into that exemption. So we'll have most likely Japan and South Korea building ships for the Navy. And look, we forgot the last few Navy defense acquisitions have been boondoggles. The Constellation-class frigate was a disaster. It was way over budget, mostly because they kept changing the freaking design mid-construction, which, by the way, is what they just did with the Ford-class carrier in the same executive order, but I digress. The Littoral Combat Ship was a freaking nightmare. We've had delays in the Ford-class. We've had delays getting the subs built. And so President Trump is saying, enough. We're going to let the South Koreans and the Japanese, who are much better at building boats than us, build boats for us. But again, that defense spending, that's one of the things that's driving that budget so high. All right, back over in Asia, though, we got some interesting data out of China this morning. China's July bank loans, the biggest decline on record. Credit creation is stalling. They are at risk of deflation, which here in the United States, you're probably like, deflation, yes, please. I understand that, but when you're heavily indebted, deflation is also a death sentence. So what's going on in China here? The Chinese consumer is really struggling. They're not borrowing. They don't want to go into debt because the economy sucks in China. And, look, we've been kind of talking about this for quite a while. The Chinese consumer is hurting. Their spending is down. And this Chinese oil consumption that just hasn't sat right with me since the start of the Iran war. Not that much ever sits right with me. But to be honest with you, the fact that the Chinese suddenly stopped importing so much oil just didn't pass the sniff test to me. Some people theorized this was an experiment to see if they could survive a U.S. blockade of the Malacca Strait by tapping into their oil reserves. Maybe that's the case. Some people figured maybe the Chinese didn't want to hurt their own industrial production with more expensive oil. Okay, that could conceivably be. Or maybe the Chinese just took advantage of that situation to dramatically reduce their oil imports because they didn't need it. Maybe they just don't need as much oil anymore because the Chinese consumer isn't borrowing and isn't spending. And you can see it in this Chinese credit creation statistic here. Now, the federal government is trying to offset that by pushing more bond issuance and having the government borrow more money for things like infrastructure projects to offset that, but not enough to juice consumption in China. So again, the slowdown in Chinese consumers continues to be a thing. OpenAI, interesting story from OpenAI yesterday. First of all, their chief revenue officer is leaving the company after less than a year. She was brought in for the express purpose of increasing OpenAI's sales to enterprises, something that Anthropic has been eating their lunch at, and continues to do so. And so she's out of there. She's going to pursue other opportunities, which means she's probably getting fired, but they don't want to say we're firing her because that might spook investors right before we IPO. Also, recently, we've had the chief operating officer has left. The CEO of apps has left. The chief product officer has left. The head of Sora Video has left. The CTO of B2B applications has left. More than a dozen high-level executives have left OpenAI this year. These are not the kind of things that happen at a company where everything is going great. But based on the press releases from the company, everything is going great. Annual revenue run rate, $40 billion, OpenAI says. What's annual revenue run rate? It's a completely made-up statistic where they take the most recent month, they multiply it by 12, and they say that's what our revenue is going to be. Nobody cares about annual revenue rate. It's a derivative. It is basically the current rate of change. It's what we're on track to do if we can keep doing what we're doing for the rest of the year. Nobody cares about that, but they always report it. And look, once again, a reminder for all the financial illiterates out there who are constantly talking about revenue as if it's a return on investment for the AI bubble. It's not. Revenue is not profit. Okay, you've got checks coming in. Congratulations, that's awesome. But the checks going out are much bigger, meaning you're losing money, which means you're not really a real business, are you? You're still just an experiment that's being bankrolled by your investors. And you need more investors in order to offset those losses and continue doing what you're doing. And the fact that they just fired their chief revenue officer, well, maybe things aren't going quite so well. Oh, that's right. They didn't fire her. She left to explore other opportunities. Somebody suggested she leave. All right, what else we got? This article on Forbes yesterday. I got to talk about this one. Forbes editor Randall Lane was fired, but why he got fired, you're going to want to know that, all right? The next time you're at your financial advisor's office and you're looking at the plaques on the wall behind his desk, just ask yourself, how much of your client's money did that plaque cost you? That story is gross. Also, we got an update on Mark Walter, the owner of the LA Lakers and the Dodgers we talked about yesterday, and Egan Jones, the rubber stamp rating shop that we talked about yesterday, found a fantastic data point about those two and the insurance companies that are in between them. And as somebody pointed out yesterday, I got a message from my buddy, the Pasta Man. He says Mark Walter only owned the LA Lakers for less than a year. Why would he suddenly sell them? Something doesn't pass the sniff test with him selling the Lakers. And I've got this story about a UK football club that might shed a little bit of light on this. All these stories about Egan Jones and insurance and private credit and the Lakers and now a UK football club. I think they're all related. Stick around for the end of the show for that one, guys. There is just so much dirtbaggery alive and well in the world of finance. But hey, you know what? Why don't we shrink my big melon of a head and let's talk about it. First, hit that like button, hype button, all the subscribe stuff. Yeah, all that stuff for the algorithm, if you please. It really helps the channel out. Right now, the S&P 500 is higher by 8 points, 0.11% in the green this morning. That would be another all-time high for the S&P. The Dow, meanwhile, is down 49 points, 0.09% lower for the Dow. And the NASDAQ is up 63 points, 0.21% higher for the NASDAQ. The U.S. dollar is weaker this morning, 36 basis points weaker. In fact, 99.60 for the Dixie. That's going to put some upward pressure on asset prices. Looking over at the commodities board, we've got yields are higher on the long end. We are going to talk about the 30-year Treasury, 5.241% for the 30-year, up by 3 basis points. The 10-year, 4.655. That's higher by almost 1.5 points. The 2-year yield is down by almost 0.5 point at 4.136. And the 1 month is unchanged at 3.691%. Looking over at commodities, we've got gold is a little bit higher this morning, $43.85 off the lows we saw yesterday, but up by $33, 0.77% higher this morning. Spot silver is at 65 and 10 cents. That's higher by 64 cents or 0.99%. I like the shiny. Copper's lower by a fraction of a percent here this morning. Platinum is higher by 0.7%. Palladium is down by about 0.5%. And WTI crude is off by 17 cents, $81.08 for September WTI crude. But hey, it's Friday, and everybody knows we have our wars on Fridays and on the weekends after market closes. So something tells me oil's not going to stay quite so dormant for quite so long. Looking over at Bitcoin this morning, $62,708 for Bitcoin as priced on Coinbase. That's off by about $700 this morning, 1% lower. All right, let's talk about the big one, the yen, and what's going on in the yen. All right, this is USD JPY. We always talk about this, guys. When this chart goes lower, that is the yen getting stronger versus the dollar. When this chart goes higher, that's the yen getting weaker. All right, here is the big yen intervention. That was Scott Bessent and the Japanese authorities defending the Japanese currency. Here is the last time they defended the Japanese currency back at the end of April, end of May. And you'll notice the last time they defended the currency back in April, May, it just started weakening again. As soon as they stopped, it just resumed weakening. And after they defended the yen this time, it just started weakening again. As a matter of fact, it's weakening faster than it weakened after the prior one. And that's the thing with artificially rigging markets. It's very much like a narcotic. The more you do it, the more you have to do it. And you need bigger, more frequent doses the longer you get. And eventually something dies, right? That's probably what's happening here. Now, let's talk about this article in Bloomberg that's pointing that out. Carry traders are exploiting intervention to rebuild their yen shorts. That is why the yen is continuing to weaken and why it's accelerating. Every intervention to prop up the yen is also creating a fresh opportunity to sell it. The historic U.S.-Japan action in the last 2 weeks ago has done little to shift the forces weighing on the currency, with the yen sliding back toward 160 per dollar and closing in on its worst week against the greenback since mid-May, the last time they intervened. The key is the wide gap between interest rates in Japan and elsewhere. Investors can borrow the low-yielding yen and use the money to buy higher-yielding assets, a strategy known as the carry trade. And they are putting the carry trades back on. That means when the intervention pushes the yen higher, investors can get a better price to sell it. Hedge funds have halved their bearish bets through August 4th. That's a few days after the intervention. But some investors are starting to return to carry trades funded by the currency, according to market watchers, including JP Morgan Private Bank and State Street Bank and Trust. Carry positions in the yen are diminished but not finished, said Goldman Sachs. They're actually on the rise again. Markets also recognize that repeated intervention is increasingly costly for Japan. Tokyo likely spent $34 billion in the currency market to support the yen on July 31st, according to Bloomberg. That followed an estimated $53 billion on the previous day, which would be the largest single-day operation on record if confirmed. All right, so July 30th was when they did the intervention. Again, here is July 30th, this big red candle, the 2-day yen intervention. Now, let's look at what happened on July 30th and the days after in, for example, the NASDAQ. Speaking of the AI bubble, well, here is July 30th. Look at that. The market was rolling over, was selling off. It's the end of the world as we know it. The AI bubble's popping, but nope. Here comes Bessent. They defend the yen, and all of a sudden, tech stocks turn on a dime, and they have been grinding higher ever since, threatening to retake an all-time high. All right, let's talk about the Kospi, right? We talked a lot about South Korea in July. Man, there was mayhem in South Korean stocks in July, right? Look at this. Oh, my God. 5% moves day in and day out, the most volatile market in history. And then all of a sudden, July 30th, they intervene. And the following trading day, July 31st, which, again, this is Asia. So the next morning, everybody woke up and you had the best day in the history of the Kospi index. The stock rose like 18% in one day, 17.9% move. And ever since then, the Kospi has been steadily grinding higher. You know, it's almost like in defending the yen, Scott Bessent actually juiced the AI bubble. That's interesting. And coincidentally, since we're adding dollar liquidity to markets, inflating asset bubbles, well, that sounds awfully inflationary, doesn't it? Think maybe that's got something to do with this story? Costliest U.S. bond sale since 2001 is investor warning to Bessent. The U.S. government sold 30-year bonds at the highest interest rate in a quarter century, a testament to investors' demand for greater compensation to finance the nation's growing deficit. The yield at the $25 billion sale on Thursday came in at 5.216, the most since 2001, even as a drop in oil prices supported U.S. debt and secondary market trading. The sale, which was met with decent demand, followed the Treasury's 10-year auction, a day earlier that drew the highest financing cost at the tenor since 2007. It's a headache for President Trump and Treasury Secretary Bessent ahead of midterm elections in November. Lofty government financing costs are already feeding through to the broader economy. After years of elevated inflation and government spending, investors are being asked to absorb a growing supply of government debt globally at a time when deficits remain large, inflation uncertainty persists, and the Federal Reserve is no longer a buyer, said Michael Stanczyk, portfolio manager of global fixed income at Allspring Investments. Long-term yields surged past 5% this year on investor concerns that a rise in energy prices tied to war in the Middle East will boost cost pressures, forcing the Federal Reserve to keep interest rates elevated for years to come. That's on top of heightened Treasury supply from years of fiscal deficits, a sudden ramp-up of corporate borrowing to fund the AI boom, and waning demand from traditional buyers of long-dated bonds. In other words, liquidity could be a problem here, especially, you notice that in the context of a Treasury auction, they're talking about corporate borrowing for AI. I mean, they're up to $500 billion. Yeah, the federal government is starting to have to compete with the AI boom to sell their debt. And what does that look like? It looks like this chart, daily candles of the U.S. 30-year yield. It has been rising steadily since bottoming out in 2020. Look, that is going higher, guys. It doesn't matter what the Fed does. All right, unless the Fed is directly buying the 30-year Treasury, which they're not doing, unless that's happening, the 30-year yield is going to keep rising because the 30-year yield is more dependent on inflation expectations than anything else. And when you've got a U.S. Treasury that is juicing liquidity in Japanese yen, thusly inflating tech stock prices, people are going to say, yeah, inflation is going to be here for a while, and so I'm not going to lock up my money for 4% for 30 years. Not if inflation is going to be even higher than that. No, I want a higher interest rate. And so the borrowing costs for the 10-year yield, they just keep going higher. And as those borrowing costs keep going higher, the cost to service that debt, the existing debt, which is pushing $40 trillion, that goes higher too. And Peter Maluk is pointing that out here. Absolutely insane stat. The U.S. is spending more on interest payments, $1.25 trillion with a T, than on national defense, which is $1.2 trillion. The cost of past debt now exceeds the cost of protecting the nation. The bill for decades of borrowing has come due. You'll notice that crossover actually happened back in 2023, and it has stayed above. And we actually see the gap is growing. Only Social Security is more expensive in the federal budget. And speaking of the federal budget, here it is possibly getting even bigger. New White House memo calls for foreign-built warships and a return to steam catapults on Ford carriers. This is in U.S. Naval Institute news. President Trump has ordered the Pentagon to consider foreign-built warships and AUKUS vessels for the U.S. Navy, in addition to other proposed changes to shipbuilding, in a sweeping presidential memo released on Thursday. Citing a lack of capacity in the U.S. naval shipbuilding base and cost growth, Trump is instead calling for more foreign investment in U.S. shipbuilding and the use of foreign ship designs that would initially get construction abroad. So look, if you're trying to juice U.S. shipbuilding, allowing U.S. ships to be built in foreign shipyards is not how you get there. But President Trump is saying the lack of capacity is now such a big problem. We don't have any choice. We have to let the Japanese and the South Koreans build boats for us, or we won't have enough boats. The Navy is really struggling with getting new holes in the water. An atrophied shipbuilding industrial base coupled with diminished adjacent supplier bases has expanded delays and increased costs. The Department of War shall restore both capacity and competition to the maritime industrial base as it expands our naval force structure, read the memo. It will use proven, reliable, and affordable technologies and ship designs, as well as award contracts that enable purchases from foreign suppliers in the near term, while simultaneously incentivizing investment in America's shipbuilding industrial base, consistent with other major equipment purchases, such as icebreakers. All right, so yeah, the whole idea of rebuilding U.S. shipbuilding is now taking a backseat to we just need to get holes in the water fast. And one of those reasons, obviously, is China. They're not saying it, but it's China. Let's talk about China. China's July bank loans post record contraction as credit demand falters. China's new yuan loans posted a record contraction in July, missing forecasts as seasonal factors and weak household credit demand weighed on lending in the world's second largest economy. New yuan loans were down 340 billion yuan, that's about 50.4 billion US in July. The largest decline on record and the second contraction this year after April, Reuters calculations based on People's Bank of China data released on Friday showed. The weakness in loan demand comes despite the fact that nominal bank lending rates have continued to edge down, said Capital Economics in a note. The recent uptick in inflation means that in real terms, bank lending rates have fallen sharply this year. Analysts polled by Reuters had expected new yuan loans in July to reach 45 billion yuan versus 1.6 trillion in June, and a fall of 50 billion a year earlier. Chinese banks typically slow lending and front-loading credit ahead of the end of June quarter. All right, so the biggest decline on record, weak loan creation. Chinese consumers are not borrowing. All right, the Chinese consumer is in big trouble, mainly because of the property market downturn. That has had a huge impact on the average Chinese family. Again, I mean, it did finally start getting coverage in the U.S. around like 2023, 2024 timeframe, but still very scant coverage at least in Western financial press of just how bad the average consumer in China is doing here, because household wealth was almost exclusively invested in real estate, and real estate prices have fallen for the last 4 years. The Chinese have overbuilt real estate to such a ridiculous extent that it's going to take them decades to recover from that. The weakness in loan demand comes despite the fact that, we already talked about that, they're lowering rates to try to spur credit creation, and it's not working. Outstanding total social financing, however, a more broad measure of credit liquidity, rose by 7.4% in July from a year earlier, unchanged from June. Any acceleration in government bond issuance could boost such financing. And that last sentence there is important. The reason why total social financing is still rising is because the government is borrowing more to offset the slowdown in the private sector. And typically what happens in China when they do that is they use local government finance vehicles, the shell companies that local governments set up in order to finance infrastructure projects. But you tend to get malinvestment that way because these local government authorities are more interested in showing economic growth to Beijing so that they can advance upward and climb the ladder within the party, and instead of actually doing economically beneficial investments. Not that we're really much better in the United States, because here we are shuffling hundreds of billions of dollars into the cash inferno that is the AI bubble. Let's talk about that AI bubble. OpenAI Chief Revenue Officer to depart after less than a year. She must have done a great job. Chief Revenue Officer Denise Dresser will be stepping down to pursue other opportunities, OpenAI says. OpenAI said Chief Revenue Officer Denise Dresser would be stepping down to pursue other opportunities less than a year after she joined the AI company. Dresser will be succeeded by Dalek Rajic. During the interim transition period, Dresser will work closely with the business team to support customers. Dresser is the latest senior OpenAI executive to leave the company following the departure earlier this week of Brad Lightcap, the company's former chief operating officer. Fiji Simo, once OpenAI's second-in-command, told staff in July that she would leave her full-time role after a medical condition worsened. The former CEO of Slack, Dresser, was tasked with growing sales among large businesses looking to adopt artificial intelligence tools in their workforces. So, her job was to get businesses to use OpenAI more. Well, they didn't. The businesses are using Anthropic. Anthropic's revenue has surpassed that of OpenAI. But they want you to forget that they're firing executives, or executives are leaving to pursue other opportunities. And they want you to focus on annual revenue run rate. OpenAI's annualized revenue tops $40 billion ahead of IPO. I hate the statistic. Stop citing it. All right. ARR, annualized revenue run rate, is nothing but the latest month times 12. It's not a real statistic. It doesn't exist in accounting. It doesn't get reported in quarterly financials or on 10Ks. Auditors don't care about it. It's a made-up statistic. They have not made $40 billion in the last year. They have not taken in $40 billion in the last year. As a matter of fact, they have lost tens of billions of dollars on much less revenue than that. And just a reminder, guys, revenue is not ROI. Revenue is not a return on investment. Revenue is not profit. Only profit is profit. And the AI companies don't have any. This greatest thing since freaking sliced bread that all of these coked up, pupil dilated finance bros keep talking about. Dude, you just don't understand the wave of technology. This is the biggest thing since the steam engine, or the biggest thing since Prometheus gave man fire. Doesn't make money. It might be all those things. It might be really awesome. It might be so technologically fantastic that my feeble value investing brain just can't get its head around. That's entirely possible. But you know what it can't do? It can't turn a profit. Not a penny of it. So stop talking about ROI. All right, now we got to talk about some absolute peak dirtbaggery that we are seeing going on in finance. This one broke yesterday, and this story just made me sick to my stomach. Forbes fired top editor over secret $6 million payment. Former chief content officer Randall Lane received the money from the founder of a research firm that works with Forbes. It gets worse. Forbes fired longtime chief content officer Randall Lane after discovering that he received a secret $6 million payment from the founder of a research firm that works for the publication, the New York Times reported. Lane received the money from R.J. Shook, the founder of Shook Research. By the way, I'm going to have AC/DC stuck in my head all day now, thanks to Shook, which has worked with Forbes for years to develop the rankings of top financial advisors, according to the Wednesday report. Forbes discovered the payment earlier this year and fired Lane in July. The payment raised concerns about a potential conflict of interest because of the long-standing relationship between Forbes and Shook. There's no such thing as a potential conflict of interest. There's no such thing as the appearance of a conflict of interest. If there could be, or it looks like, that's because it is a conflict of interest. All right? Don't let this soft language. Oh, people always say, don't worry. It's obscene to think that the appearance of a conflict of interest. I would never. Yeah, you would. You took $6 million, buddy. That is not the appearance of a conflict or the potential of a conflict. All right, that is 100% a conflict of interest. Now, why is this? Okay, let's talk about it a little more. Lane and Shook had known each other for years while their professional relationship grew alongside Forbes' partnership with the firm. He says, I made a mistake, and I take responsibility for it, Lane said in a statement to the outlet. I should have disclosed the gift, and failing to was a serious error in judgment. I deeply regret that, and I lost the job and team I love because of it. None of this changes how I feel about Forbes and the amazing people there. Oh, I made a mistake. I should have disclosed the gift. No, you didn't make a mistake. You didn't fail to disclose a gift, all right? Some guy getting you a shot glass or a T-shirt at the duty-free shop on his home from the airport, that's a gift, especially from a guy to another guy. But $6 million, that's a bribe, you crooked, corrupt a-hole. It's not a gift. It's a freaking bribe. So why would this research firm have bribed the editor of Forbes for $6 million? Shook works with Forbes to produce lists including America's top wealth advisors and best in state wealth advisors. The rankings use qualitative and quantitative criteria, including interviews with financial advisors and data such as revenue trends and assets under management. Forbes' published methodology says neither Forbes nor Shook accepts fees from advisors in exchange for placement of its ratings. Are you sure about that? Are you sure nobody's taking any fees? Where did that $6 million come from? Shook has described its ranking process as independent and objective. Yeah, like objectively, whoever pays me the most becomes the best wealth advisor in America, according to Forbes. The research firm evaluates thousands of candidates each year, considering factors including assets under management, revenue, client retention, compliance records, industry experience, and business practices. Let me spell this out. Let me say what the rap isn't saying. This corrupt asshole was taking millions of dollars from the research firm that told Forbes who was the best financial advisor in America, and then Forbes would publish that data. All right, do you think maybe people read Forbes and think, oh, this is the best financial advisor in America, I'm going to send them my money? And do you think that might actually be a very valuable thing to those wealth advisors? And do you think wealth advisors are such magnanimous people that they are above bribing the research firm that comes up with that list to put them at the top of it? So the next time you're at your guy's office, your financial advisor, and you're at his desk, and he's got all of his plaques on the wall behind him, along with a degree in political science from some college you've never heard of, and you see a plaque there that says Forbes on it. Ask yourself, how much of his client's money did that plaque cost? And, well, that came directly out of the returns that you might have earned had you not gone to somebody who bribed their way to the Forbes list. This is freaking gross. Also gross. Yesterday, we talked about Mark Walter, the owner of the LA Lakers, who got caught using his insurance company investors' money as a slush fund to loan to his own business interests, and how he was suddenly selling the Lakers to Bob Iger and Josh Kushner in order to raise capital to ostensibly recapitalize those insurance companies or avoid prosecution. Well, those two insurance companies are ClearSpring Life and Delaware Life. And I got to send a shout out to the Junk Bond Investor on X at Junk Bond Invest, who posted some pretty interesting thing, because we also talked about Egg & Jones, which was the private label rating shop that's getting in trouble because they're rubber stamping dog shit AAA. If only that had ever caused problems before. Well, if maybe there was some historical warning about how that could be a problem. Well, it turns out ClearSpring and Delaware Life, the two insurance companies that are owned by Mark Walter, the guy who's getting in trouble and is now forced to sell the Lakers, that they used Egg & Jones for 70% and 37% of all of their ratings, respectively. Now, I theorized that this was going on yesterday in my stream, and that's why I covered that article on Egg & Jones right after I covered the article about Mark Walters, but I didn't have the data to back that up at the time. Now we do, thanks to Junk Bond Investor. Excellent work here. Here we go. ClearSpring Life, 70% of all of their private credit loans on their books were rated by Egg & Jones. And Delaware Life, also owned by this Dodgers Lakers a-hole, 37% of the loans on their book were rated by Egg & Jones. Egg & Jones, who had 25 guys working for him and somehow rated 3,200 private credit deals last year with 25 people. It's a rating shop. And so now, again, as my friend the Pasta Man pointed out, why would this guy, Mark Walter, why would he be selling the Lakers less than a year after buying them? And I didn't have that data point yesterday. I didn't realize that Walters had just bought the Lakers in October, and now he's selling them already. And then I saw this story. Fund manager boss banned over making fake claims to buy football club. Now, this is a different guy, different sport in a different country, but I suspect maybe this story might shed some light on what's going on with the Lakers. A fund management executive was banned by the UK finance watchdog for making false claims about his financial position in a bid to buy a bank and a football club. Paul Taylor, then CEO of Blue Horizon Asset Management, was fined £480,000. That's a laughably small fine for a guy like this. And banned from working in the UK financial services by the Financial Conduct Authority, according to a statement on Friday. All right, so this guy has been kicked out of the industry and fined £500,000. While attempting to buy an unnamed British bank and the Reading Football Club, Taylor falsely claimed to be the owner of a £200 million bond portfolio in a bid to convince the firms to lock him in as an exclusive bidder. Taylor purported to be the ultimate beneficial owner of the bond portfolio to show that he was good for the cash and trigger an exclusivity period while bidding on the bank and later the football club. The portfolio was in fact being managed by Blue Horizon for a client who the FCA didn't name. Blue Horizon described the portfolio as liquid assets that could be monetized quickly if needed to fund the purchase of the UK regulated bank and the soccer team. It's common practice for people to purport to have funds to purchase businesses and then try to raise it subsequently, Taylor told the FCA in an interview. He said that he never intended to use the portfolio to actually fund the acquisition. He used his client's money as proof of funds to try to buy a bank and a soccer club. And now he's banned for life from working in this industry, and he's being fined £500,000. Now that's interesting. If that's going on with a soccer club and this private asset manager over in the UK, now think about that guy who bought the Lakers, who owns an insurance company and is already in trouble with the regulators for using his insurance company investors' money to prop up his failing private credit loans. Is it so unreasonable to speculate that maybe something like this was going on with that purchase of the Lakers and by extension, the purchase of the Dodgers? Were they using clients' money as proof of funds to buy a freaking basketball team? And I think what's probably going to happen when the dust settles, I think we're going to learn that everybody does this, that they all do this, because owning a professional sports team is like the ultimate bragging rights for these uber rich a-holes. They all love to do it. They all want to be the next Mark Cuban. And look at what he's saying here. It's common practice for people to purport to have funds to purchase of businesses and then try to raise it subsequently. I always struggle with that word. It's common practice. Everybody does it. Everybody lies about their client's money being theirs and uses it as proof of funds to buy a bank and a football club. What's the matter with you guys? Everybody does it. Good God. What crime, what scumbaggery, what dirtbaggery. And again, on top of all this, the asset managers, the newspaper, the media, financial press outlet that ranks them was accepting bribes to ostensibly to put people at the top of that list. And guys, this right here, all of these stories is one of the reasons why I started this channel. I cannot stand all of the sell side bullshit that is just permeating the financial media industry. And the financial media industry, understand who owns them and who controls them. It's their advertisers. And who are the advertisers in the financial services industry? It is the firms that want your money to collect fees off of it. The same firms that are piling into data centers right now. And the same people who are being brought into this roundtable discussion on CNBC with Jensen Huang to talk about how awesome the AI bubble is, even though nobody makes any freaking money off of AI yet. Except Jensen Huang. He's getting filthy rich off of it. And your money's paying for it. That's why I started this channel. That's why I don't take money from these a-holes. Somebody's got to talk about this stuff. Might as well be nobody. Hey, I just want to say thank you, everybody, for having your coffee with the Melonheads this morning. Don't forget all that algorithmic good stuff, the like button, the hype button, the subscribe button, please, if you will. Thank you also to my magnanimous Melonheads on YouTube, Patreon, and Buy Me a Coffee for supporting the channel. You guys are awesome. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.